Welcome to the Smart Money Tracker introductory video series. In these videos you will learn the smart money strategies of the wealthy in today's market. I'm your host, Brian Netzel. Here's our disclaimer. This presentation is educational in nature and is not a solicitation to offer, buy, or sell securities. It's intended for educational purposes only and is not a guarantee of earnings or profits, as individual effort and circumstances greatly influence the profitability of any financial endeavor. We are not financial advisors or tax advisors and do not practice law. For financial, tax, or legal advice, one should seek the counsel of a licensed professional. In the last video, we saw that one must account for inflation, stock market fluctuations, and the future of Social Security in any solid financial plan. In this video, we'll critique what financial advisors of the middle class typically recommend to their clients by evaluating the results. And what I mean by that is evaluating the results of their advice. While most of us have been raised to follow the advice of financial experts, low returns are making many people reevaluate what they've been taught. Challenge 7. The typical financial advice that most people get. What do the experts of the masses advise people to avoid the pitfalls and maximize their returns? And how well do these typical solutions work? Dollar cost averaging. Has anyone ever told you that you can increase your overall returns by buying with dollar cost averaging? This common strategy may seem like common sense, but have you ever stopped to think about the result? If you buy shares of a stock over time, you'll be paying what is said to be an average price for the stock over the course of time. Now, let's think about that. If you invest a consistent amount of money into a single company each month, are you really maximizing your investment dollar? Michael Edisis, Partner and Chief Investment Officer for Fair Advisors and author of The Big Investment Lie, says no when he critiques this commonly held myth about the superiority of the dollar cost averaging technique. He said, on average, investing a lump sum all at once gave you a much better investment return than investing it piecemeal with dollar cost averaging. Diversification. Have you heard before that those who want to mitigate risk in the stock market should diversify? The main method most busy people use to diversify their investments in stocks is through mutual funds. In this way, it's said, the common person can invest in a host of stocks, thereby spreading risk across a spectrum of industries. A classic example of how this investment philosophy sounds great on paper but does not guarantee results in real practice happened in the 80s with Janus Funds. Janus was a huge player in the mutual fund industry at that time. With a host of funds to choose from, young hotshot fund managers, and a seemingly wide variety of investment objectives, Janus was the go-to fund family for billions of dollars. If you would have studied any one of their multiple choices for funds, you would have seen that each fund had a different manager, strategy, and objective. One invested heavily in technology, another in consumer goods. One invested in large companies, another in smaller companies. At first glance, it seemed that if you were to spread your money around to a handful of their different funds, your money would be so well diversified that you would be protected. If one industry was devalued, another would be on top. At least one would think. Price-earnings ratios were at all-time highs, and no one thought that stocks would go anywhere but up. The test came in the stock market downturn of 2000. No one thought that a general downturn could affect so many stocks and so many different sectors. Technology stocks plummeted and many lost their lifetime savings. How did diversification protect investors from harm? And what about the diversity of funds that the Janus Group touted as a way to protect one's savings from an industry-specific downturn? If Janus funds were so different from each other, why did they all go down in the same market downturn? Stories emerged that Janus funds were not as diverse as believed. Since they had a common lunchroom at Janus corporate headquarters, fund managers who were working on very different funds would eat lunch together and talk about the stocks they were thinking about buying or selling. What resulted was that over time, the Janus funds became more and more alike. so much so that they were hardly distinguishable from one another when the market took a downturn and cut nearly all of them to a discount from just weeks before. So much for depending on diversification alone to protect our future. What we don't know is going on behind the scenes can really hurt us. Buy and hold in the stock market. You've likely heard that buying and holding stock long term will address a lot of the ups and downs in the market. I recall a friend who, upon the death of his mother, was sorting around her heirlooms in the attic when he came upon a small wooden chest that contained dusty Pacific Gas and Electric stock certificates from 50 years before. After stock splits over the years, these few paper documents of 1,000 shares represented a tidy sum. Yes, buy and hold does work if you can hold long enough and you don't have to pass them on to your heirs to benefit from the long-term growth. For most people today, though, the buy and hold philosophy sounds more like invest and forget. You'll recall Enron, WorldCom, and a host of other companies that in recent times looked like very conservative companies, but then they went bankrupt. Add financial giants Arthur Andersen and Lehman Brothers that were taken down by bad reputation and bad investments respectively, and you can quickly conclude that one must engage in constant evaluation of one's stock investments rather than invest and forget. Go more conservative. Some might conclude that with all the risk of the market, it's better to just be as conservative as possible to avoid problems. Investing in bonds or CDs might seem like the way to avoid risk, but then inflation will outpace the rate of growth of these types of investment products. 1% in your money is, as someone opined, going broke safely. How about timing the stock market? We've already discussed the problem of timing when someone must start to withdraw from a retirement account at 70.5 when the market is down. The difficulty in timing the market also applies to being able to know when it's a good time to jump into the stock market. Those who feel they can outsmart the market must have a system to avoid the human tendencies of fear and greed. If you have a system to time the market so you know when to invest, and if you've conquered the human tendency toward fear and greed, you need to share your insights with humanity because you've found a much greater secret indeed. While a topic of such importance as long-term financial planning and wealth accumulation deserves a profound level of support and intelligence, it's unfortunate that so many people fall into an assortment of pitfalls due to just the opposite. In addition, there likely exists no other area of human discourse that is so fraught with peril from vested opinion. So-called advisors often must be pressed to admit their profit motive for the counsel they give us. Pundits seem more driven to give short-term advice about a hot new stock or mutual fund than telling us how to build long-term wealth. And while the stock market can be a vehicle for retirement that may pose dangers for the uninformed, it is at least easy to do. Yet because of the flat returns and unpredictable nature of stocks, many are looking to diversify their portfolios in alternative ways to how they've been taught by the traditional media channels. Conclusion: what we've been taught about how to invest for the future is not working out like many hoped. It may seem depressing to realize the many perils associated with the typical ways that people plan for their retirement years, or for those years where they just want to be financially free. Left to the newest, hottest investment choices, we fall prey to sales techniques and someone else's agenda. I recall a friend who was within 5 years of retirement and had just listened to another salesman present another investment magic pill. With a bit of frustration in his voice, he asked me why today's salesman always seems to have a better way than yesterday's salesman. Would you agree that what you've been taught and the advice you've followed in the past has gotten you to where you are today? We often must use the knowledge and contacts we have today to make decisions that affect tomorrow. In this video, we've evaluated the results of the typical type of advice given to the middle class by financial experts. We've learned that to get exceptional results, we cannot follow the advice of those who produce inferior results. In the next video, you'll learn how the wealthy make decisions to uniquely position themselves to gain regardless of the market. In this video series, you'll continue to get valuable information that helps you take charge of your financial future. The purpose of the Smart Money Tracker is to provide timely market and investment information that equips our members to match the best strategies of wealth generation that exist today. If you would like to track and match the best wealth building strategies that exist today, visit our website. Or if you are not yet a registered member, we invite you to join to receive full access to our resources, including a full version of our Smart Money Strategies e-course, member forum, resources, vendor directory, case studies, and more. Visit thesmartmoneytracker.com. Until next time, this is Brian Netzel.